misafirlerimiz, programımıza kaldığımız yerden devam ediyoruz. Şimdi sıradaki oturumumuz olan Merkez Bankası oturumu, düşük büyüme ve düşük faiz ortamında para politikasını modere etmek üzere Türkiye Cumhuriyeti Merkez Bankası Başkan Yardımcısı Sayın Turalay Kenç'i, konuşmalarını gerçekleştirmek üzere de EBRD Baş Bölgesel Ekonomisti Sayın Bojan Markovic'i ve İtalya Merkez Bankası Başkan Yardımcısı Salvatore Rossi'yi sahneye davet ediyoruz.
Oturuma hoş geldiniz diyerek başlamak istiyorum. Ben de önce konuşmamı ülkemizi tehdit eden, halkın huzurunu bozan, terörist eylemlerde şehit olanlarımıza Allah'tan rahmet diliyor. Yakınlarına sabır ve metanet dileyerek başlamak istiyorum. So with this, let me move on to the session. This is on monetary policy in low growth and low interest rate environment. I was prepared to make some remarks on that, but this session is already behind the schedule, and more importantly, both speakers have a flight to catch, so I'm going to skip my remarks, so directly move into the session. To do that, I like to introduce the two great and distinguished speakers that we have. So the first speaker is deputy or senior deputy governor at the Bank of Italy, and the second speaker used to be central banker as deputy governor at the Central Bank of Serbia, or National Bank of Serbia. I need to get these things right. But these days he's with us here in Istanbul. He's working at the EBRD. But before that, let me say a little bit more about our speakers. First, I will start with Salvatore Rossi. He has a long central banking career, which is almost 40 years. And he headed the research department at the Bank of Italy and eventually became senior deputy governor. But, well, what is important about him that under his leadership, Bank of Italy researcher really developed great ideas and research on very good topics. And as a result of that, Salvatore Rossi and his team is the author of various articles, essays, books on the topics such as international economy, economic politics, and history and industrial economy. There are many things to say about Salvatore. One of them is that in 2013, the president of Italy named Salvatore Rossi among the 10 wise men for the task to devise a policy platform for a new Italian government. Well, congratulations for that, Salvatore. In Rossi, what we have, not only a knowledgeable person, but also senior and a wise person. Well, it doesn't only stand here. He's from the Euroland, where the problem that we are going to discuss, which is the monetary policy in low growth and low interest environment, is much more pronounced than any other region in the world, I would say. And more than that, Italy probably the epicenter of this problem over the years. So we have great to have Salvatore Rossi in this respect. Let me move to Bojan. As I mentioned, he used to be central banker, but before that he was a student at the United Kingdom. He received his MSc degrees and PhD degrees from the University of Birmingham. What is important about Bojan is the fact that he is really truly central banker in the sense that he has a dissertation in the area of monetary policy, and his thesis title was that credit channels of the monetary transmission mechanism. And well, he has a couple of other noteworthy progress along these lines. So he worked at the Bank of England, and he worked at Goldman Sachs. So he has a very good career to be a great panelist here. So with that, probably I should leave this and start with Salvatore to say something about the experience they had in Italy, the experience that the Eurozone is having about monetary policy in low growth and low interest environment. The floor is yours, Salvatore.
Thank you. Good afternoon to everybody. Thanks for inviting me to participate in this very interesting summit. Let me start with some preliminary considerations regarding the role of interest rates in our economies. It might seem obvious to you, but it's worthwhile to recollect the reasons why we are so obsessed with interest rates. Changes in interest rates affect a number of variables and behaviors of economic agents. The value of wealth accumulated by savers, their propensity to save, the financing cost for borrowers, for entrepreneurs, and for households, the evaluation of investment projects, the sustainability of fiscal debt, the stance of monetary policy, of course, and the list would go on and on. Now, we know that in many advanced economies, nominal interest rates, both short-term and long-term, are now at historically very low levels. That's a fact. That's a very well-known fact. And they have been low for several years by now. This environment, this is an important point to my opinion, should not be viewed merely as a consequence of the central bank's reaction to the global financial crisis that we experienced 7, 8 years ago. In a longer term perspective, it is also sort of end point of a trend. Just let me remind you a few data. Since the early 90s, well before the global financial crisis, the 10-year nominal yields on government bonds, let's take this usual benchmark of long-term interest rates, have declined by 11 points in the UK, 9 points in the euro area, 6 points in the US and in Japan. Shorter nominal rates have followed the same pattern, though with a much larger volatility. How come? What are the associated risks of this environment of low interest rates for a prolonged period of time? And what are the policy challenges that this environment are posing to us? In trying to answer these questions, let me first recall that the nominal interest rate can be viewed as the sum of three components. The real interest rate, the expected inflation, and the term premium. Now, economic theory tells us that the real interest rate is the price at which the supply of savings is equated with the demand for funds, the demand for funds aimed at financing investment. Supply and demand, in turn, are determined by various factors, such as the preference of households to smooth consumption into temporarily over time, and the productivity of capital. The expected inflation and the term premium components of the nominal interest rate are self-explaining. No need to explain. When buying a long-term bond, I want a return high enough in order to compensate me for the potential loss in purchasing power that I may suffer in the future, and for the risk of a potential capital loss that I may have if I want to sell the bond prior to maturity. A lot of influencing factors are involved here. Expectations about future economic growth, about inflation, households' willingness to shift consumption across time. I said that before, the degree of risk aversion of economic agents, financial markets volatility, and so on and so forth. Which of these factors can explain more the current low interest rate environment? I would indicate two sets of factors, transitory ones and structural ones. The latter are particularly important, the structural ones, since they may suggest that the current environment is a long-term phenomenon bound to stay with us for quite some time. The transitory factors are evident, are well known. First of all, the expansionary monetary policy stance put in place by many central banks, most central banks, in response to the global financial crisis, and in the euro area also to the sovereign debt crisis. We know that most central banks in the advanced countries, as policy rates were reaching the zero lower bound, have enriched their monetary policy toolbox with various unconventional measures, the most important and visible one being the QE, the quantitative easing programs of securities purchases. Another important transitory factor behind this low interest rate environment is the deleveraging by the private sector. That's also a legacy of the financial crisis. This deleveraging is also determined by financial regulation becoming stricter and stricter, definitely stricter than before the financial crisis. And here comes the structural factors, the most dangerous ones. They can be summarized as follows: an excess of desired saving over desired investment, leading to lower economic growth and lower real interest rates. This is essentially the secular stagnation hypothesis that was proposed by Larry Summers a year ago. I would like to quote Barry Eichengreen. Barry Eichengreen was one of the most prominent economic historians of our times. He has recently written an illuminating article published in the American Economic Review on this topic, and he discusses four possible explanations. First, high saving rates in emerging market economies. This is the well-known global savings glut hypothesis put forward by Bernd Bernanke a few years ago. The idea is that in some emerging countries, but he had in mind China in particular, social protection systems are so limited and so weak that households feel forced, compelled to increase their precautionary saving. Second, the decline in the relative price of investment goods, machinery, equipment, ICTs, thanks to technological progress. For a given investment project, a fall in the relative price of investment reduces the demand for funds. With less investment spending chasing the same funds, the same savings, the result can be lower interest rates and potentially a chronic excess of desired savings over desired investment. Third, a lower rate of population growth, demographic factor, very important in the advanced economies especially, but also we are seeing some phenomenon of that kind in emerging markets as well. The fourth possible explanation is the more controversial one. The idea is that the pace of scientific and technological inventions has slowed down since the golden era of the 20th century, electricity and then ICTs, and will never recover, causing a corresponding permanent scarcity of high-return investment opportunities. The American economist Robert Gordon is a supporter of such a pessimistic view. Let me say immediately that I don't believe in this fourth factor. I don't buy this Robert Gordon's story. The innovative capabilities of humankind have always caught philosophers and economists by surprise, century after century, year after year. But the other three factors are serious, are very serious, and deserve to be addressed. And let me now briefly touch upon some policy implications of all this. Nearly 8 years after the financial crisis, these days, global growth is still modest on average, with a high variance across countries and across regions. The US recovery is continuing at a sustained pace, but growth in the euro area and also in Japan is currently still modest, though expected to pick up next year. Emerging economies' growth will decline this year for the 5th year in a row on average, although these economies will continue to increase their share of global GDP, and that's the Turkish story as well. Against this outlook, monetary policy stance across major economies may become asynchronous in the coming months when, if and when, the Federal Reserve will actually start the announced normalization process. And the big question is, how much transitory are the transitory factors explaining the current lower interest rate environment? And the second question is, will the structural factors prevail and keep real nominal interest rates low forever, or at least for a very long time? On the first point, we know that in the aftermath of a financial crisis, economic recessions tend to be more severe and more lasting than in typical business cycle recessions. There's a famous paper by Reinert and Rogoff showing that. In other words, credit cycles last longer than business cycles, but eventually they come to an end once households and corporates' balance sheets have been repaired. And that poses the problem of how and when normalizing monetary policy, and that's the debate that we are seeing in the US especially. Another policy challenge relates to possible spillover effects on emerging markets of changes in the monetary policy stance in advanced countries. I know that this is an issue which is particularly felt as urgent and important in most emerging economies and even in this country. The reason is evident. Large capital flows went to emerging market economies in search for yield in these years, putting upward pressure on asset prices and on exchange rates. They might suddenly reverse when monetary conditions change in advanced economies, starting with the US. And the risk is that the process becomes disorderly, with impaired liquidity in certain markets or asset classes. These risks call for clear and effective communication strategies by central bank. This has been, sort of mantra repeated several times in the various fora of debate on international economic policy, cooperation and coordination. The G20 in particular, under the Turkish presidency, this has been a very important issue in our discussions. But also emerging economies should further strengthen policy buffers and further advance structural reforms in order to cope with this risk, which is a potential risk, not necessarily an event that will happen anyway. Finally, what if the current low interest rates were the new long-run equilibrium, the new normal? In this case, I would see relevant risks to price stability. Central banks might more often encounter the zero lower bound on nominal rates, losing room to maneuver to counteract deflationary shocks. The economy would be less resilient to negative shocks. Central banks might have to increasingly resort to what we call unconventional policies, but the fact is that we do not know exactly how effective these tools are as a normal business cycle stabilizes, and what macroeconomic risks they might entail. And let me conclude signaling another risk that I deem quite important, and probably less debated than others. We are experiencing a sort of macroeconomic conundrum, puzzle, mystery, paradox these days. Economic policies, in the aftermath of the financial crisis, became exceptionally accommodative in order to save the world from another Great Depression. Financial panic was destroying households and corporates' confidence. It was curtailing aggregate demand, and so it was felt that macro policies, both fiscal and monetary, had to fill the gap as long as it was needed. But the ensuing prolonged phase of very low nominal interest rates has produced the following paradox. Since a saving is not rewarded enough, at least to the eyes of savers, on one side, the search for yield gives perverse incentives to take more risk on board, and this jeopardizes financial stability. On the other side, households feel compelled to save more because they see, for instance, their insurance policies or their retirement schemes at risk of not being fully honored. And this is partially offsetting the policy stimulus that we wanted to exert on our economies after the financial crisis. And so one main lesson comes from these considerations, and this is my conclusion. The most effective and long-lasting solution is to tackle the declining trend of real interest rates from the supply side, that's the right side, by implementing structural reforms to boost productivity and support job creation. You know, structural policies are too a sort of mantra in our debates right now, but I mean, there are real strong, true arguments in favor of structural reforms, and that's one of them. We need to prove Robert Gordon's prophecy wrong. The consequent increase in potential economic growth would raise the real component of the interest rates and would push nominal interest rates into what will be definitely a safer territory. Thank you.
Okay. Thank you, Salvatore. You're really excellent to describe the problem. It was very useful to construct your ideas into two groups, so transitory factors and the structural factors behind low interest rate, and then you mentioned the challenges of this low interest rate environment, and very good account of challenges in the case of the policy normalization. So now with that I turn to Boyan. It's your turn, Boyan, to say something about this pressing issue.
Turay, thank you very much, and thank you for your kind words at the beginning. It is a great pleasure to speak in what is now my city. I can only subscribe with everything Salvatore said, so let me just try to add up and maybe purport some of his conclusions. And let me start from personal experience. As Turay mentioned, I was Deputy Governor in charge of monetary policy, but in the Bank of England I was in charge of the official model for forecasting inflation, so I was on both sides of making monetary policy. And monetary policy before the crisis seemed to be relatively straightforward. Central banks were changing key policy rates in order to affect aggregate demand. There was a bit of complication in some of the emerging markets, especially those with high level of dollarization in the economy, because those emerging markets had to intervene in the FX market and reduce volatility of the exchange rate. But on balance, monetary policies before the crisis seemed to be very successful both in terms of disinflation and coping with various shocks. And that earned monetary policy makers a reputation that they can do wonders. Now, the reason why monetary policy was successful before the crisis was indeed partly because of central bankers became better, so partly because of the better policy making. But it was also partly due to a good luck. The fact that in 10 years before the crisis, we mostly had demand shocks, which are relatively straightforward to deal when central bankers are concerned. They move inflation and output in the same direction. Now, how did monetary policy work in that case? Well, of course, monetary policy makers were making decisions, so there was a role of judgment, but they were able to rely quite a lot of input from models and inform their judgments based on models. Now, how the monetary policy really works in this environment, which Salvatore explained, might be transitory, the transition lasts for quite long, or may turn, at least partly, to be a permanent modus vivendi for policymakers. Well, first thing is that in front of the central banks, who were largely in charge only for monetary policy before the crisis, we now have multiple goals. In particular, financial stability is now increasingly becoming an officially recognized goal for central bankers. The crisis, the financial crisis, has shown how financial stability is important. It has shown that micro banking supervision is not sufficient, and we should rely on some of the macroprudential instruments to maintain financial stability. Various macroprudential instruments are used. Examples include in Turkey, in Southeast Europe, reserve requirements, loan-to-deposit ratio, provisioning policies. Now, those policies are often in line with monetary policy goals as well, but sometimes goals of financial stability and monetary policy can differ, presenting an additional challenge to monetary policy. In dollarized economies, highly dollarized economies, there is an additional challenge on how to manage dollarized part of the economy. So many of the central banks, realizing that FX exposure is also very important, have to rely even on other instruments such as foreign currency reserve requirement to manage dollarized part of the economy. And in global financial situations, so globalization of finance, the decisions on the macroprudential measures in one country can affect another country, therefore further complicating monetary policy makers making in countries. Let me give you one example. In Serbia, in order to deal with too large credit exposure and try to attenuate credit boom that happened before the crisis, we have introduced reserve requirements, pretty high reserve requirements, on bank lending. But what happened is that given that quite a lot of, say, Austrian banks had subsidiaries in Serbia, they have simply shifted their customers to their parent banks in Austria, therefore circumventing reserve requirements that we imposed in Serbia. What does it mean? This means that if we want to have efficient dealing with financial stability, we need to coordinate macroprudential policies across the countries. And I'm quite hopeful in the ability to coordinate those policies through the Bank for International Settlements. We have actually did some things which may ensure this coordination is placed. Now, the second thing I want to point out, which is different, apart from having more goals for monetary policy makers, is to having to rely on more instruments for monetary policy makers. We have all heard for quantitative easing, and we have all followed what's happening with quantitative easing in the US. So in many countries we have, Salvatore mentioned, the zero lower bound constraint for the interest rates. That means that if we have a prolonged recession, very long growth and so on, we can reduce interest rate, but we can't make interest rate easily negative, certainly not a lot negative. Now, what it means is that we have to rely on some other instruments which are not tested, that can be quantitative easing, or some other instruments. But because these instruments are not tested, that also means that the role of judgment in policy making is now much more important, and there are less models that can help inform the judgment. Of course, in some countries, quantitative easing is not possible. One has to have a very deep capital markets to be able to do quantitative easing and purchase various bonds without affecting the pricing in the market. So many of the countries faced with zero lower bound constraint, who can say Switzerland, they don't have deep capital markets, had to rely increasingly on exchange rate interventions or managing the exchange rate in order to conduct the monetary policy. And of course, whatever happened in these countries, developed countries, also affected, Salvatore mentioned that, the emerging markets, in markets that didn't face zero lower bound constraints, such as Turkey, Indonesia, Brazil. Because whatever happened with global increase in liquidity due to quantitative easing, it also increased the volatility of capital flows to many of the emerging markets. So it's not that only countries with zero lower bound constraint were affected by new instruments, but also other countries because of the global funding situation that we actually have in the past decades or so. Now, what also changed is that in such circumstances, the role of communication in central banks increased significantly. Some of the central banks resorted to something that some formalized ways of communication, such as forward guidance, by either announcing a full part of future interest rate changes or giving an indication on future interest rate decisions. But certainly, better communication in terms of what one can expect in circumstances when interest rates are not the only instrument of monetary policy making is necessary. And indeed, like we saw that the Turkish Central Bank recently has issued some of the guidance of how the instruments will be used depending on the circumstances of normalization. The next thing I would like to stress with change, and that's related to my PhD thesis that Turalay kindly mentioned, is that the character of the transmission mechanism changed. So the interest rate channel got stuck in many countries. What does that mean? That means that when the central bank changes interest rate, that doesn't necessarily mean that the interest rate for a corporate that wants to borrow changes as well. Now, why that happens is that in countries where the major way of borrowing is through banks, the interest rate channel seems to get stuck more. Banks seem to sit on liquidity in many countries, therefore making decision-making for monetary policy makers even harder. Now, why do banks sit on liquidity? Well, for two reasons. First, banks also face the new situation with multiple goals: financial stability, monetary policy, which changing macroprudential situations, and they're naturally reacting by building up some reserves. But also there is another thing which is particularly pertinent in countries that are changing drivers of growth, and comes from the fact that banks, when deciding about lending, are relying on historically based credit models. So think about the countries like the UK or Serbia. Those are the countries that had large current account deficits before the crisis. What does that mean? That means that for 10 years, consumption was the major driver of growth in those countries. So corporates that did well before the crisis were either corporates that were importers or services, but certainly not many of the exporters. Now, after the crisis, those countries had to adjust their external balances. Current account deficit had to go down. That means that corporates that did well before the crisis will not necessarily do well after the crisis, and vice versa. But when banks use historically based models for credit assessments, those models are becoming less informative in terms to which corporate the bank wants to lend money, leading to what many could describe more risk aversion, but certainly leading to the fact that liquidity gets stuck in banks and is not necessarily channeled to the final destination, to corporates, to growth. Now, what is the solution? Well, exactly what Salvatore said. Monetary policy has to be combined with structural policies. First, corporate restructuring becomes very important to reinvigorate the interest rate channel. And in countries that have high non-performing loans, resolution of non-performing loans becomes very important to reinvigorate the interest rate channel. It also means that in relative terms, exchange rate channel may be getting more important relative to interest rate channel, tempting many policymakers to engage into competitive devaluation, and that is something that we should strive to avoid. And the final consequence that I would like to lay down is that the role of fiscal policy is becoming more important. In countries where monetary policies have reached their limits in what they can do, fiscal policy is the one that should do more. And when I say fiscal, I don't only mean budgetary policy, I also mean governmental policies in terms of doing structural reforms. In EBRD, we have an indicator called transition indicator, which is actually a set of things that indicates the difference between the practices in a particular country with best practices in the world. And we followed that country by country. And what we saw is the transition indicators kept increasing until 2005, 2006, but then got stuck in most of the countries after that. Now, transition indicators are indicators of structural reforms. That means that structural reforms throughout EBRD's countries of operation got stuck. And without structural reforms, it would be harder to reinvigorate growth. It would be certainly almost impossible to sustainably reinvigorate credit growth. Without structural reforms, we will likely have a period of low growth, low interest rate lasting longer. Now, of course, fiscal policies can help in other ways. In countries with large current account deficits, to avoid a large pressure on the exchange rate, fiscal policies can do something that we economists call internal devaluation. Large current account deficit essentially implies that a country consumes more than what country produces. So fiscal policies which would lead to a change in the relative weight of consumption and investment, productive investment, may actually help attenuate the pressure on the exchange rate. So to conclude, there are many more challenges in front of monetary policy makers nowadays, and the usual wisdom that monetary policy can do wonders that was around us before the crisis should probably be a bit relaxed. Monetary policy can do a lot of things, but there are limits to what monetary policy can do, and there is a great potential for other policies, such as structural policies, to do more in this current environment. Thank you.
Thank you, Bojan. Well, you have given an excellent account of the recent changes in monetary policy making. Let me count some of them. The first one is the changes on the objective of monetary policy, and then the role of communication. The forward guidance has been used quite extensively, and the transmission mechanism change, you rightly pointed that out, the capital market intermediation taking a greater role, at least in certain countries, and the interaction between monetary policy and structural policies, and the FX channel that you mentioned, and also the last point you mentioned is quite important, the role of fiscal policy. So with that, I am going to unfortunately say that we have no time for questions because both speakers have to catch a flight. So thank you very much for coming. Thank you.
Sayın Markovic, Sayın Kenç, Sayın Rossi teşekkür ediyoruz.